Hi, Stan The Annuity Man. Today's topic is a wing-dinger. It's how annuity companies make money on fixed index annuities. Boy, there's a lot of misinformation out there, and I'm going to try to make it very simple for you to understand why the annuity companies have the big buildings, right? I mean, they're smart, but some of the misconceptions and some of the ideas that people have about indexed annuities we need to cover. So at the end of this, you're going to understand how they make money on indexed annuities, and if it's a good deal for you, and if you even need one. In addition to that, make sure you watch my other video on disadvantages of fixed index annuities, where I cover even deeper on that product. Boy, do we have a lot to cover on this topic, and I love this topic, which is how do annuity companies make money on fixed indexed annuities. So we're going to cover a lot of things. We're going to cover, what is a fixed index annuity? What does it solve for? How does it work? Then we're going to talk about how annuity companies make money on annuities in general. Why do they have the big buildings? Why do they have those big logos on those jets, right? They're smart. They know things, right? Life insurance companies know when you're going to die. That's the reason they have the big buildings, and property and casualty companies don't know when the hurricanes are going to hit, for all you Floridians out there. So you understand that. And then we're going to go over the details of how they make money or not make money on fixed index annuities. At the end, we're going to talk about where they fit, the limitations and benefits of the product, and also hang in there through the video, because at the very end, I'm going to tell you how to get a free book that I've written on fixed index annuities. So what is a fixed index annuities? Now, if you've been to the Bad Chicken Dinner seminar where the guy's up there in a bad leisure suit telling you about this product sounds too good to be true, it is. Never forget, if it sounds too good to be true, it is every single time without exception with annuities. And with fixed index annuities, boy, the hype is crazy. I mean, this is the best thing since sliced bread. I mean, if you don't buy it, you're crazy. You and I both know there's limitations and benefits to all products. So what is a fixed index annuity? It's a fixed annuity. That's the first word, fixed annuity. You're never going to lose any money. That's a good thing, right? Now, it was put on the planet in 1995 to compete with CD returns. And guess what it's done historically? It's competed with CD returns. All of this hype of market upside with no downside, market participation, principal protection, instead of 8-minute ads, it's 6-minute ads, right? I mean, if it sounds too good to be true, it is. That doesn't mean it's a bad product. You just need to understand how it works. And it works to provide enhanced CD type returns. That's what a fixed index annuity is. All right, so let's talk about how fixed index annuities work. Now, typically when I start this, I warn people, it's kind of like showing paintings to blind people. No offense to blind people. It's tough. I try to take it down to a 9-year-old level. No offense to 9-year-olds. But I'd always say, if you don't understand it, if you can't explain it to a 9-year-old, you shouldn't buy it or sell it, right? So a lot of people out there that are pushing these indexed annuities, fixed index annuities as the one-size-fits-all solution to your life. Calm down, Sparky. It doesn't work like that. These are contracts, so it's not too good to be true. So let's talk about just the nuts and bolts about fixed index annuities. Number one, it's a fixed annuity. It's protecting your principal, fixed. Now the gains part of it, where the hype and all the people go crazy at the Bad Chicken Dinner seminars and on these TV commercials you see where it just says, you turn to your wife and go, hey, that sounds pretty good. Why wouldn't we get that? That's perfect. Because it's not. The gains are based on a call option on an index. A call option is like a 1-year bet saying that I think the index is going to go up. And if it does, you get to lock in that gain with a limit. Now see, this is where all of the sales pitch stuff comes in. And you got to be real careful, because annuity companies aren't in the business of giving anything away. There's no philanthropist at an annuity company that says, you know what, I want to give things away. No, they're going to provide a good product, but you got to understand in full what that product is. So the basics of how fixed index annuities work, there's a cap on the upside. There's a limitation on the upside, and those rules are dictated by that carrier and can be changed at their discretion. And also understand you can attach what's called a lifetime benefit income rider to a fixed index annuity at the time of application if you want income later guarantees. So that's kind of how a fixed index annuity works. So what do fixed index annuities solve for? Once again, fixed, principal protection, and it provides enhanced CD type returns historically. That's what it provides for. It can also provide a lifetime income guarantee if you attach that income rider at the time of application, if that specific annuity offers that. Okay, we're getting ready to get in the weeds, so just bear with me. I'm going to go slow because I want you to understand how annuity companies make money on annuities. Let's talk about, just from a broad standpoint, regardless of type, how do annuity companies make money? Here's the basics, okay? When you give money to an annuity company for a fixed annuity of any type, the regulators say that the annuity company has to have the money in bonds day one. So the annuity company has your money in a bond portfolio, a huge one, and the interest that they get off of that bond portfolio, they give you some and they keep some for their profit. At the end of the day, from a 30,000-foot view, that's how annuity companies make money on your money, regardless of annuity type. Now, remember I told you that annuity companies invest in bonds and they take some of that interest off, give it to you, and they keep the rest for profits? Now, with indexed annuities, fixed indexed annuities, instead of them giving you the interest like on a multi-year guarantee annuity, a CD type annuity, they take that interest, that portion, and they buy the call option, that index option, on the indexed annuity. So that's what they're doing with that money. Let's go over some common misconceptions that people have about indexed annuity carriers, and I get calls like this all the time that are wrong, and I'm so happy to clear all of this up. Number one, the annuity companies do not make money buying the index options. They make no money buying them. That's the first thing you need to know. The second thing you need to know, the carriers, they don't make any money on the index option. They're not making money on the index option participation. They do not keep the difference between the caps and the spreads, the limitations that are in place. They don't keep that. That's a common one. Everyone's, well, I only got 4 and they kept the rest. Incorrect. That's not how it happens. What happens is when they buy the index option, when they buy that option, they're typically buying it from one of these large investment banks. All of those blue blood guys with like $3,000 suits. I mean, they don't have cool stuff like I wear, but they're wearing these Brooks Brothers stuff, etc. They'll probably want this hat, but that's another story, okay? So they give them the money to buy the option, and the investment bank is absorbing that risk of what happens with the performance of that index option. So, once again, the index annuity companies buy the option from the investment bank. They don't make any money on that, and they're transferring the risk to that investment bank, the JP Morgans and all those rich, smart Ivy League people, to absorb that performance of the option. Also understand the reason that there are caps and limitations on the upside for indexed annuities is that's all the annuity company can buy. That's all the upside they can buy while protecting your principal. Remember, fixed indexed annuities, fixed, protecting your principal. So if the question is, why is my cap, why is my limitation 4% or 5% on the upside for that option? It's because that's all they could buy with that money, that interest money that they allocated to buy the option. That's all they could buy to protect your principal. Because at the end of the day, remember this, fixed indexed annuities are fixed, right? They're principal protection products first. They're not market products. They're CD type products. They're fixed products. Now, to just add to the party, I know I'm throwing a lot at you. It's like a fire hose of fixed index annuity information, but you can always, replay it and go slow, right? So let's go over one more thing. At the time of application, with most fixed index annuities, you have the option or the ability to attach what's called an income benefit rider, which is a future income guarantee. Now, if you do that, the annuity company is going to hold on to your money longer. Why? Because when you turn on that income benefit payment is based on your life expectancy at the time you take the payment. So in addition to them making money off your money from just buying bonds, they're also going to have a longer time to make money off your money buying bonds if you use the income rider for future income, because you're going to stay in the policy longer. So again, you kind of see how they're making money. Just baseball analogy, they're not hitting home runs with your money. They're hitting bunt singles for a long time. So if you think of it like that, they're not killing it. They're just incrementally making small amounts with a bunch of money. 2 final key points, which I think is very important for you to know. Annuity companies are smarter than banks. Okay? They're more regulated than banks. When you give money to a fixed annuity company for a fixed index annuity, the regulators require, there's no option, they require the fixed index annuity company to buy bonds, investment grade type bonds. They can't go do risky stuff with your money like a bank. That doesn't mean they're better than banks, it just means they're handcuffed. They can't do crazy things with your money. So they're handcuffed from the standpoint that annuity carriers from what they can invest in. It's got to be investment grade bonds. So understand that. And the other thing that I think is important to understand is when you buy a fixed index annuity, the surrender charges are really, really, really high. Why is that? Number one, there's a built-in commission that goes to the agent. Number two, because of they're buying the options and all this stuff, administrative costs, for the first few years, the annuity company is in the hole. I'm serious about that. I know you're crying tears for them, but it's true. And that's the reason that the surrender charges are so high, because if you pivot and say, I want my money back, then they're going to have to make up for some of that money they've been investing in the options, etc. So it's a long-term play for them as well. Let's go over quickly the benefits and limitations of fixed index annuities. Obviously, the benefits are principal protection, you get CD type returns, you're never going to lose a penny, and any type of gains do lock in permanently at that contract anniversary date. That's a good thing, right? You can also attach an income rider for future benefit for income. The negative really revolves around the environment of the overhyping of the sales message, market upside with no downside, market participation with full principal protection. Remember, they were put on the planet, fixed index annuities, in 1995 to compete with CD type returns, okay? Are there some anomaly years where they do a little bit better? Yeah, sure. But at the end of the day, blended returns, just go into a fixed index annuity if you buy one with the understanding you're going to get CD or better type returns. If you do that, you'll like the product. But if you go into it thinking you're going to kill it with, get 7, 9, 10% every single year, come on, you're smarter than that. You know better than that. It's not designed like that, and it doesn't work like that. Remember the first part of the video, I said, hey, if you hang in there with me, you're going to get some free books. Thanks for hanging in there with me. I mean, it's been a great topic, but it's detailed. I hope you really learned a lot. But I'm going to give you these books. All you got to do is go to the link below and sign up. Index Annuity Owner's Manual, Income Rider's Owner's Manual. I've written both of them. I'll send them to you for free. We won't call you. We won't bug you. You'll just get them in this really neat gold Willy Wonka package. And then you can read about it. You can rewatch this video, and you'll understand how fixed index annuities and income riders work.